You're living thousands of years ago. You've got a goat and you want some grain. So you find the farmer with sacks of barley and say, hey, how about we trade? If he's hungry for goat stew, perfect. You've got a deal. But if he's vegetarian or just doesn't like goats, you're stuck dragging your bleeding friend around the market hoping someone else wants him. That's the barter system. Goods for goods, need for need. Trade was simple, direct, and often a total headache. The whole thing depended on what economists like to call a double coincidence of wants. Both sides had to want what the other had. That's not exactly efficient. Still, for early humans, it worked well enough in small villages. As societies grew, barter became less practical. So people got creative. Instead of swapping goats for grain, they started using things that everyone thought were valuable. These were the first proto-monies. Take cowrie shells, for example. Bright, shiny, and small enough to carry around, they became the world's favorite ancient currency. In fact, they were used in Africa, India, and China for thousands of years. The Chinese even based their written character for money, bei, on the shape of a shell. Other cultures went for whatever made sense locally. Cacao beans in Central America, salt bricks in Rome, tobacco leaves in colonial Virginia. Salt was so important that Roman soldiers sometimes got paid in it. That's where the word salary comes from. And not all proto-money was convenient. In the Pacific island of Yap, they used massive limestone discs as currency. Some were as big as car tires. Couldn't slip one into your pocket. Many weighed tons. Instead, the whole village just agreed on who owned which stone. If a family bought a canoe, the ownership of a stone might move, even if the stone itself stayed put by the road. It might seem ridiculous, but it worked because everyone accepted the system. Money wasn't just about swapping stuff. It was about shared belief. If everyone agreed a bean or a shell had value, it was enough. That's really the secret behind all money. Eventually, though, people realized they needed something sturdier and more universal. Metals were the answer. They soon became the next step in humanity's search for reliable value. They didn't rot, they didn't get eaten by bugs, and they could be shaped into standard sizes. In ancient China, they experimented with funky shapes, knife money, and spade money. These were literally little bronze objects shaped like tools, miniature daggers and shovels. Why? Because tools symbolize labor and value. This was a step closer to real currency. The big breakthrough is around 600 BCE in the Kingdom of Lydia, somewhere in modern-day Turkey. When people began minting metal into round shapes, the first coin was born. They used electrum, a natural mix of gold and silver, and stamped them with royal symbols. That little mark was genius. It said, "This coin is official. The king says so." Coins spread rapidly across the ancient world. The Greeks adopted them, stamping their owls and gods on shiny discs. The Persians followed, and Rome got into the coin game. Coins made trade faster and easier. Soldiers were paid in coins. Merchants counted profits in coins. And ordinary folks could finally carry wealth in their pockets instead of on their backs. Centuries later, the Chinese carried wealth not in heavy coins, but in fragile slips of paper. In 11th century China, during the Song dynasty, merchants faced a serious problem. They were doing long-distance trade, hauling goods across dangerous roads. Carrying big sacks of metal coins wasn't just heavy, it was an open invitation for bandits. So they came up with promissory notes. Basically, IOUs written on paper, backed by trusted merchants, and eventually the government. Soon, the Song state made it official. The world's first government-issued paper money. A piece of paper was worthless on its own, but because everyone trusted the government's promise, it became money. This was a massive turning point. Money went from being locked to scarce stuff like goats, shells, or gold, to being linked to something you could crank out almost endlessly, paper. As merchants roamed across continents, bankers offered ledgers and bills of exchange as safer money. In medieval Europe, markets are buzzing, merchants are shouting prices, and somewhere in the chaos, a Florentine banker is quietly inventing a system that changes money forever. Instead of lugging bags of coins from Venice to Bruges, you could carry a piece of paper that promised the coins would be waiting at your destination. The Medici family in Florence took this idea and ran with it, building one of the first real banking empires. The power of money wasn't just in gold or silver, it was in the expectation that promises would be kept. This turned bankers into power players and laid the foundation for modern finance. Fast forward a few centuries, now silver is the star. By the 16th century, Europe had discovered the New World and immediately started digging it up. Mountains of silver poured out of mines in Potosi, in modern-day Bolivia. The Spanish turned that silver into coins called pieces of 8, which became the first true global currency. You could spend one in Madrid, in Mexico City, or in a market in China, where silver was in huge demand. Pirates loved it too, by the way. If you stumble upon a treasure chest filled with glimmering coins, chances are those were Spanish silver dollars. The world had a single currency that linked Europe, the Americas, and Asia. And with that, money stopped being just local. It had gone global. But silver had a weakness. Its supply kept shifting, and its value fluctuated too much. Gold, on the other hand, was rarer, more stable, and easier for governments to standardize. So in the 19th century, nations abandoned silver and turned to gold, giving rise to the gold standard. It meant that every note, every coin, was backed by a fixed amount of gold, locked up in vaults. If a pound sterling said it was worth a certain amount, you could, in theory, walk into a bank and demand the equivalent in gold. This system gave international trade a sense of stability. Nations recognized each other's currencies because they relied on the gold behind them. But stability had a price: inflexibility. When the world hit the Great Depression in the 1930s, governments needed to print more money to keep economies alive. But the gold standard tied their hands. One by one, countries abandoned it. The lesson was clear. Gold was solid, but too rigid for the messy realities of modern economies. So what do you do when the world finally gives up on gold? You get fiat money. It's the fancy term for the money in your wallet right now. It has no intrinsic value, no gold, no silver, no seashells, just the promise of your government that it's worth something. When President Nixon pulled the US off the gold standard in 1971, he basically said, from now on, money is worth what we say it's worth. And somehow, it was successful. People accepted it. That's the magic trick of fiat. It runs entirely on collective belief. As long as we believe that others will take our paper bills, it keeps working. This also opened the door to inflation, recessions, and governments printing way more than they probably should. But without fiat, modern economies simply wouldn't function. While gold and fiat money were shaping economies, the rich and traders had their own favorite tool: checks and promissory notes. If you've ever written a check, you've played with one of the key bridges between old-school money and modern plastic. Checks were a way to move money around without actually moving it. Sign your name on a slip, and your bank account did the heavy lifting. By the 18th and 19th centuries, the wealthy were writing checks like crazy, avoiding the hassle of hauling coins or bills. Businesses loved them too, and banks built entire systems to verify and clear them. This also meant new opportunities for fraud. A bad signature here, a bounced check there, and before long, trust got wobbly. But despite the risks, checks lasted for centuries, hanging on even into the late 20th century. They were a stepping stone, showing us that money didn't always need to be physically present. It could move through promises, signatures, and numbers in the system. Then came plastic rectangles that let people spend money they didn't even have yet. In the 1950s, a businessman in New York named Frank McNamara had a problem. He went out to dinner and forgot his wallet. Embarrassing, right? To avoid that ever happening again, he came up with a clever idea: a cardboard charge card called the Diners Club card. With it, you could eat now and pay later. The restaurant sent the bill to Diners Club, and the company collected the money from you afterward. At first, only a handful of restaurants accepted it, but the concept spread fast. That little piece of plastic spread like wildfire. Visa, MasterCard, American Express. People weren't limited by what was in their wallets. They could buy now, pay later. This was more than convenience. It rewired consumer behavior. Debt became normalized, shopping became easier, and a swipe or tap turned into a cultural habit. The plastic era wasn't just about money, it was about psychology. Spending didn't feel like losing money instantly. It felt almost painless, and that changed everything about how societies consumed. By the late 1990s, another shift was brewing. The internet was exploding. Money lost its shape entirely. It became pure digital flow. No more waiting in line at the bank or mailing checks across the country. With online banking, your account moved with you. Then came PayPal in 1998, making it possible to send money across the world with a click. If you were selling something on eBay, you didn't need to risk a stranger's check. You just needed their email and a PayPal account. It was money stripped down to pure data, buzzing across servers in seconds. This was the beginning of cash becoming weightless. The internet turned money into a stream of bits and bytes, and with that shift, the world felt smaller. Once smartphones arrived, buying the world was just a tap away. Walk into a street market in Shanghai or Beijing in the 2010s, hardly anyone uses bills. Instead, they whip out their phones, scan a QR code, and the deal is done. In China, apps like WeChat Pay and Alipay became so dominant that cash practically disappeared in daily life. Meanwhile, in the West, Apple Pay and Google Pay turned phones into wallets. The convenience was addictive. Even small street vendors and food trucks joined in, accepting payments digitally. Money became a buzz in your pocket. But the story doesn't stop at convenience. The 2008 financial crisis shook trust in banks and governments. In response, money took a new form, one built on math instead of institutions. In 2009, Bitcoin arrived, the rebellious child of the financial world. Unlike any money before, Bitcoin wasn't tied to a government, a bank, or even physical reality. It ran on blockchain technology, a decentralized ledger that anyone could see, but no one could control. Early adopters saw it as digital gold, free from the grip of Wall Street or central banks. There's even the legendary tale of the first real-world Bitcoin purchase. 2 pizzas bought in 2010 for 10,000 BTC. Back then, it was a fun experiment. Today, that would be worth hundreds of millions of dollars. Whether you see it as the future of finance or just a speculative bubble, cryptocurrency forced everyone to ask a deep question. What is money really, if not trust? For some, blockchain was the answer. For others, it was a gamble. Either way, it added a new twist to the centuries-long drama of money. So where do we go from here? Some say the next step is central bank digital currencies. CBDCs, think of them as government-approved crypto. Digital dollars or digital yuan issued straight from the central bank. No paper, no coins, just numbers in an official app. Countries from China to Sweden are already testing them. The idea is both exciting and a little eerie. On one hand, it could make payments seamless, efficient, and safe from counterfeiting. On the other hand, it means governments could track every transaction you ever make. From barter to Bitcoin, the journey of money has always been about 2 things: trust and convenience. And while the forms keep changing, the core remains the same. Money is just the tool we invent to keep life moving. The rest is a very human story of making trade a little easier and maybe a little more exciting.